Hello and welcome back. Today we are going to continue our small discussion concerning withdrawals. And you see on the overview here, we are now dealing with tax exemptions and similar things. Well, let's immediately begin. For the purpose of tax exemptions, one has to check thoroughly if the wording of the exemption does really cover what happens in case of withdrawal. It could be that the wording only covers comparable transactions, but not a withdrawal. A famous example, for example, has been a court decision that if you rent or let your building for rent to others, my rental contract, that this is tax-free, but if you use it for your own purpose, this is not a rental contract, so not covered by the exemptions wording, and so it would not be tax exempt but liable to tax. Sometimes there might be then surprising effects. It might be that sometimes also the non-applicability of an exemption seems to come just from the perspective of the fiscal administration or the perspective of the lawmakers of a certain member state. For example, in Germany, there is a rule that the tax exemption for experts does not include things which have been withdrawn from the enterprise. It has been explicitly added some years ago in paragraph 6.5. So the definition of an export at the end says, well, exportation, and so that does not apply to goods which are withdrawn. The underlying interpretation of the course of events or of reality is evidently that if you withdraw something into your private sphere, that happens in your enterprise. And when you then make a package and send it to a friend abroad in a third country, then you already act as your private self. And what the private person does is no longer a delivery which could qualify for an export. So the idea is evidently you take an asset out of your enterprise, and a minute later, not the enterprise owner acts anymore, but the private self of the enterprise owner. And so what a private person does, if a private person sends something as a gift abroad, that's no longer a delivery. And so that can no longer qualify as an export. So strange. You just need to read it and know it. And it shows that sometimes things where you might on the first glance think it's clear, sometimes need some special knowledge. However, we can also think about another example which shows that, well, there are examples where the tax exemption works for withdrawals. Imagine that an entrepreneur had a building constructed for his enterprise 20 years ago. The construction of a new building causes value-added tax. It also caused that at that time. And so input tax could be claimed by the enterprise at the time because they bought the building for enterprise purposes. And now after 20 years, the owner of the enterprise says, I don't use the building anymore for my business. I am now going to use it for private purposes only. So this is a withdrawal. The asset now changes to the non-entrepreneurial sphere. So that is automatically to be treated as a delivery for consideration, because when that building was acquired, it entitled to input tax deduction. The place of delivery is determined according to the usual rules. That is a place where the building is located. We assume that's in Germany, so the whole thing is taxable. And naturally, what I forgot to mention immediately now was also the event takes part within the scope of the enterprise activities, because you remember the definition. The enterprise comprises everything, the whole entrepreneurial activities, everything which has a connection with the enterprise. And you know, Not only the main activity which turns you into an enterprise is meant, but also all additional ancillary activities, things which happen from time to time in the course of the life of an enterprise. Well, and that you have to dispose of fixed assets or other assets of the enterprise by a sale, by withdrawing, or things like that. That happens in the course of an enterprise. It's a sufficient connection with the enterprise, so that is within the course of the enterprise. So taxability is there, but then we check tax exemptions, and there is one exemption in 4 number 9, letter A of the Umsatzsteuergesetz, which says that deliveries of real estate property are exempt from VAT. The background is that in most states of the EU there is a specific real estate transfer tax on selling real estate property. So one wanted to avoid a double taxation with indirect taxes, and therefore when the first version of the VAT rules was written, the member states at that time all agreed real estate transfer should be free of value-added tax, because most of us have an extra tax on that. So deliveries of real estate are exempt from that. Now the withdrawal is deemed to be a delivery in the VAT directive and in the German legal text. So we have a Lieferung, a delivery of real estate. So the conditions of that legal rule are fulfilled. So the withdrawal of the building is regarded as tax-free. By the way, that if you have a kind of a creative imagination, you would now immediately find the possibility for a trick. You would think, okay, then I buy or have built a building officially for my enterprise, and then, surprise, I withdraw that a short time later and turn it into a private house. However, that trick wouldn't work, because the designers of the law, the lawmakers, knew of the risk of abuse of things which have entitled to input tax, and so there is a rule: if a withdrawal happened relatively shortly after the acquisition, repair, renovation, or anything else in connection with an asset which entitled to input tax deduction, then a correction of the original VAT deduction can be made under the famous rule of paragraph 15a Umsatzsteuergesetz to prevent an abuse. And that rule would mean or imply that the amount of VAT input tax which you can keep is cut back to that amount which is indeed only a fair share for that time during which the asset stayed in your enterprise and was used for purposes which really entitled to input tax deduction. So there is already something which prevents the usage of that loophole. Well, when we have the tax exemptions checked, then logically the next step is, if it's liable to tax, we need to look for the tax base now. And the tax base is defined here in paragraph 10.4 for withdrawal transactions and similar things. The tax base for the withdrawal of a good is defined as the amount for which the entrepreneur could acquire a good of the same quality and age at the moment of the withdrawal. The legal text speaks about the purchase price or the cost of production in case of situations where you can't purchase it but have to produce it yourself. That usually ends up misleading beginners and others, because you read something about purchase price, then you say, this book, this car also was purchased by me 3 years ago for 100 euro or for 30,000 euro the car. So this is my tax base. And the answer is no, it is not. Because the rule goes on and says the purchase price at the moment of the withdrawal. So not the purchase price which you spent on the good in question 2 years, 3 years, or 4 months ago, but the price which you would have to pay today on the purchase of that good. And that's a difference. Why? Why not the historical price? Why is that fair? It seems to complicate things. However, we can explain and understand that by examples. Imagine, for example, my favorite example is you are the owner of a grocery shop and you bought a salad, very fine salad, big one, on Monday. So you spend €2.14 on the salad, €2 net price plus 7% German value-added tax. Now the salad lies around there in your shop and waits for customers. It's fine weather outside, 30 degrees, 35 degrees, 40 degrees. Your air condition doesn't work properly, or it's a very sunny place in your shop. So what happens to the salad in the course of the days? It changes a bit its outer appearance. So Tuesday afternoon, customers begin to avoid looking at that salad. Approximately Thursday evening, even bacteria try to avoid the salad because even they fear for their health. On Friday morning, you think you should remove that salad. Either throw it away or take it home and feed it to, is it a tortoise, which you might perhaps have in your garden, which you can feed. Probably they are willing to eat it still. You will try out. So that's a withdrawal of the salad. However, we don't want untaxed consume. Now the value of the salad is definitively no longer €2. You would be lucky if somebody pays 10 cents for it. So it can't be fair to charge you if you take it home with more than the VAT on the 10 cents. Because what you consume now has no longer a value of €2. This is 10 cents rubbish. So it would be unfair to charge you with €2. What happened here, the explanation for the drop in value is, well, as every trader has to face the phenomenon, that happened here too. You bought a good and it didn't find a customer who was interested. So it declined in value, and at the end you had to get rid of it for a far reduced price, or you had to throw it away. So that loss of value was just cost, general cost of the enterprise. That was not consumed, so that should not be taxed. So it's fair to define the tax base this way. On the other hand, it could also happen that a good which you keep in your store increases in value in the meantime. Doesn't happen so often, but might happen. Imagine 25 years ago, you met a student, a guy interested in arts, and did some paintings. That was John Strange, completely unknown at the time. He was on the verge of poverty, so you decided to support him tactfully, and you bought one of his paintings for €1,000, plus VAT perhaps. So now you put it into your gallery or into your office on the wall, but let's even imagine you put it into your gallery. You are a gallery owner, so you trade in art. Naturally, as it was not the painting of a genius, you have hidden it a bit. And indeed, nobody ever was interested in buying it. The years pass by, you nearly forget the thing. However, John Strange, in the meantime, has become a very famous person. He painted more and more. He developed a talent for marketing. Apart from that, he was an astronaut. Then he twice tried to become president of the USA, ended as president of the People's Republic of China, so is highly famous now. And now you still have his painting on the wall in your gallery. And on a courageous day, you say, I'm now never going to sell this. I take that home and put it on my wall because this is a kind of a memory. Although in the meantime, naturally an early painting of that genius would be highly researched and estimated by customers. So probably now this painting has a market value of 500,000 or even a million. If you now decide to use this for private purposes, now your private consumer definitively has no longer a value of only 1,000, but definitively of a million or of 500,000, whatever one can estimate as the price which you would have to pay as a gallery owner for the acquisition of that painting today. And we can reasonably assume that a repurchase of a similar painting from that famous painter nowadays would not trigger only a price of 1,000, but probably 500,000 or more. So that would be a fair price for you. Yeah. A last question, by the way, why is it not the price which you would charge to outsiders, to your own customers, but only the price for which you could buy it today? And there is a simple answer. First, it would be a bit cynic to force you to make a profit on your own. And second, well, there is always for you the alternative not to withdraw that asset now, but to order a similar asset immediately for private purposes from your own supplier. They would supply you at the present retail price. And so there would probably be no possibility to enforce the taxation of a higher value, because we could just avoid that by clever design of our behavior in the real world. Okay. Now, another remark seems to be necessary. You remember probably that windscreen wiper case, the famous Armbrecht case of the European Court of Justice. There the court held that if you withdraw, if only parts of the good which you withdraw from the enterprise entitled to input tax deduction, then only the withdrawal of these parts triggers withdrawal taxation. Then naturally the tax base is limited to the repurchase value or reproduction value of these parts at the present time. Well, now still, just to underline it again, where you can find that definition of that tax base in paragraph 10.4 of the Umsatzsteuer, that the first number is the withdrawal tax base definition for the withdrawal of goods, so what we are just speaking about. And you should already store deeply down in your minds that you always need the definition of the tax base in 10.4 in all cases where 10.1, the regular consideration or the gross price minus VAT, does not exist, or if it does not lead to an adequate result because this tax base, the 10.1 tax base, could have been manipulated downwards. So 10.4 is always where you look if 10.1 gives not a reasonable result. So naturally, you remember that everything or nearly everything which we can find in the German VAT Act must be underpinned by orders of the EU, because there is the Value-Added Tax Systems Directive of the European Union, which in a very detailed manner orders what the member states have to do, are forbidden to do, and where they have options when they write their VAT laws. So it's also interesting to have a look again into the VAT directive. There we find the underlying rule, which is basically the background for 10.4. in Article 74. And as that is interesting for all of us, I hope at least, I copied the wording here. Where a taxable person, that means an enterprise owner or an enterprise, applies or disposes of goods forming part of his business assets, or where goods are retained by a taxable person. Let me translate. Where you withdraw a good into your private sphere, or where you close down your enterprise and then not sell some of the goods, then you retain them. And well, in that case, you would also use them in the future for non-entrepreneurial purposes, so for private consume probably. As referred to in Articles 16 and 18, then the taxable amount shall be the purchase price of the goods or of similar goods, or in the absence, so if such a purchase price does not exist, the cost price. And now the decisive final statement comes, determined at the time when the application, disposal, or retention takes place. So also here you have that decisive command that the purchase price of today, the repurchase price or the retail price of today counts, and not the price which you paid 3 years, 20 years, or 3 months ago. Oh. So we are here on the safe side under the aspect of European Union law. Then we come to the tax rates, and with regard to the tax rate, there's nothing special to say. The tax rates for the withdrawal of goods are exactly the same as for the sale of these goods, because naturally it's the purpose of the withdrawal rules to treat withdrawals exactly the same as if consume had been taxed regularly. So at present, the rates would be in Germany 19% for nearly everything, 7% reduced rate for certain foods or so a few drinks, and 10% also for books or in other goods. And since a few years, 0% tax rate for certain photovoltaic devices, which means that if you have a photovoltaic device on your rooftop, and in former times you bought it and entitled to input tax at a time when this tax exemption for your output did not yet exist, then nowadays you could withdraw it into the private sphere at a rate of 0% then. Yeah. The difference, by the way, to a tax exemption is not easy to explain. We might talk about that later. However, as the 0% rate here exists only for that single item, photovoltaic devices, and until now for nothing else, we should not deal too much with that. So I'd rather see it as a kind of a curiosity, which is meant to support the change over to renewable energy sources. Well, more interesting might be the formal aspects. However, more interesting, okay, for formal aspects is basically always boring. Let's begin again with the taxpayer. The taxpayer is the enterprise or the entrepreneur. The same rule as always applies. 13a, number 1 says taxpayer is the entrepreneur in all cases where number 1 applies. That's not a big surprise because there is no one else. In case of a withdrawal, you don't even have a customer to whom you might shift things like by reverse charge mechanism or things like that. There is only the entrepreneur, not even a counterpart in the contract. So it's the only candidate, and if there is only one candidate, that candidate wins. So clear case, taxpayer must be the entrepreneur. When does the tax arise? So when is the first moment when we have a tax liability and we can begin to pay, or the moment from which on the clock ticks? Let's say deadline 10 days later or 40 days later. However, When the tax liability begins to exist, when is that? In case of a withdrawal, if we read the rule in 13.1 number 2, that's a specific rule for withdrawals, this rule tells us the tax becomes existing at the end of the preliminary declaration period during which the event happened. Now that is first surprising, because that's exactly the same formula as in the regular rule in 13.1 number 1. So one is sometimes a bit puzzled, huh? Why? Why a different rule? Now, if you have a closer look at the regular rule in number 1, then you will find out that in number 1 there is sometimes an option for especially small and medium enterprises. Usually you have to pay the VAT once you made the transaction, so before the money comes. That can be a huge financial burden. So for small and medium enterprises, they can apply for a special option that they are not yet taxed when they made the transaction, but only when the money flows in, so that they can pay VAT on a cash flow basis. However, if somebody uses that option, then you have a problem with withdrawals, because if you withdraw something to your private sphere, money never flows in. You can't make a payment to yourself. So for that reason, there is number 2, which clarifies, okay, in case of a withdrawal, no opting out of the regular rule, then always the regular rule applies. So if you withdrew something in March to the private sphere, even if you're a small and medium enterprise, the rule is then at the end of March you will have to declare and pay the tax on that withdrawal. So makes sense, you can't make it differently. Let's talk about invoicing. That's cleverly and quickly done. You don't write an invoice to yourself, no? Do you? Withdrawals. So an invoice is nearly not possible there. What might be an idea is if you give away for free things to your staff members or to complete strangers. That also might trigger a withdrawal tax. And it might be that these strangers then use the goods in question again for entrepreneurial purposes. That might give rise to the question if then it would not be fair that these people get an attestation how much VAT is underlying the gift which they got from you. However, if that is legally possible, and under which circumstances it would be legally possible, is questionable. I'm very doubtful if it would work. So is a question. So, and we are not going to deeply dig into that question. We are beginners, we don't need to find it out. However, we must see there's a problem naturally. Declaration duties are nothing special. So you hand in, if you're an entrepreneur, you hand in the tax declaration. There will also be a line which asks you how high have your withdrawals been in this declaration period, and you fill it in. By the way, naturally, when you speak about the tax base, if your repurchase value is a gross price, then you would have to deduct the VAT included therein. However, in most cases, your accounting or your cost calculation immediately delivers you net figures. So then usually 10.4 is just a cost figure, a net figure, and so there you will probably just add VAT on top. Last remarks. Very often when we come to the question input tax deduction, there is some confusion in the minds of beginners, which is sometimes replaced by misconception or confusion in the minds of advanced people, because your subconscious always thinks the following: hey, that was private consumer of the entrepreneur show, so we private consumer is taxed, so we should deny input tax deduction. Or cancel it retroactively. However, that would be wrong. That would be extremely wrong, because input tax deduction is not granted if the output is tax-free. However, we just had a withdrawal, so we just taxed the withdrawal at the correct market value at the time of withdrawal. Then, naturally, to cancel the input tax would be a second financial burden on the same thing. So that would be unfair. And now you might still wonder, why don't we just cancel the input tax? That would be sufficient. No, think again back to my example, concerning the salad which you buy on Monday and take home on Friday morning. There's a huge difference between the value at the moment of purchase historically on Monday, €2 net price, excellent salad, and the value which really counts for consume at the moment when you withdraw the salad, 10 cents, because it's plain rubbish on Friday morning, or you probably can't justify to eat it. And so it would be unfair to tax you on the basis of the €2. It would also be unfair to cancel the input tax. Because where did that salad lose value in the meantime? Well, in the enterprise waiting for customers. So the loss of value here between Monday and Friday is just a part of the usual cost of any trader. Every trader knows you will buy goods. Not all these goods will be sold, so several of them will lose their value. You will have to either throw them away after a while or sell them far below purchase price after a while when you are sure they otherwise you don't get rid of them. This loss of value is just not consumed. It's just something which happens as part of the general cost of a trading enterprise. So it would be unfair to deny the deductibility of these costs for a trade if you don't sell these goods for 10 cents but withdraw them with a value of 10 cents. So keep in mind, input tax is not revoked in case of a withdrawal taxation, because the withdrawal just leads to a correct output taxation. These things are fully liable to tax, and whatever is liable to tax entitles to full input tax deduction. Well, that is something which you must clearly have in mind, because otherwise you probably make it wrong. Well, by the way, what we also have to keep in mind is, or what's a good possibility to remind us here of, is if you buy something which is from the beginning onwards immediately meant to be used for private purposes, or for the usage of your staff members, or to be given away for free to others, then this good is not bought for the purpose of your enterprise, because the purpose of your enterprise is producing output, taxable goods and services. And if you immediately buy something with the intention to use it for the private consume of yourself or your staff, it's not bought for the purpose of the enterprise. So then you can't get input tax deduction from the beginning on. And then if input tax is not deductible, then naturally a withdrawal taxation later cannot take place, because you remember, withdrawal of a good requires that the good in question has entitled to input tax. So naturally, that's the first thing you have to check. If you buy something, do I buy it for the enterprise? Or do I just use the enterprise, let's say, account and ordering forms to buy something for my private sphere, so that it never becomes an enterprise asset, or never becomes a part of my production process. So imagine you immediately have in mind, I ordered chocolate as a Christmas present for my employees. Then that is no input tax deductible purchase, because you don't buy for purpose of your production, but you buy something immediately as a present for the private needs of your staff. So you buy it for private consume. You never get an input tax deduction, so you don't have a withdrawal later when you hand out the chocolates to your employees. If, however, the enterprise is a food shop and orders a huge amount of chocolate as trading goods, and then later, before Christmas, the owner says, "Oh, what do I give to my employees?" Well, chocolate is always a good idea, and takes from the storage rooms some chocolate. Then this chocolate was genuinely first bought for entrepreneurial purposes, and then withdrawing it for staff purposes is then indeed a taxable withdrawal and would trigger withdrawal taxation, because then you had full right to, it was not abuse, to claim input tax deduction, because originally the goods were meant for trading purposes and only later were withdrawn. That would be a decisive difference. Okay, that is, I believe, enough for today. So be happy that you again did some stuff here. Enjoy a bit of a break, and then later I hope to see you again soon for the next part on the next informations on withdrawals. Thanks for watching, and goodbye.